This may sound crazy, but General Motors, yes, the legacy automakers, outperformed Tesla stock for well over a year now. Now, depending on exactly the date that you pick, given the massive volatility in Tesla stock, there are still short periods of time where Tesla has outperformed GM. But if you go back to the start of 2022 to today, both of these stocks are down, but Tesla is down 50%, GM is down just 22%. If you go just the past year, GM stock is up 32% and Tesla is down 18%. So this is a pretty wide margin. And this is actually as the economy is getting to a more normalized state. We're getting out of some of the bubble territory of the pandemic, the strange trading that happened in 2020, 2021, all those shortages that we had in the auto market. So in a more normalized environment, GM is actually outperforming Tesla. So I'm here today to answer exactly why that's the case and why I think that's going to be the case in the future going forward, because Tesla's business is just not living up to the expectations that investors are putting on the stock. This is what investors always have to think about is what are you actually paying for? What sort of expectations or future growth are already priced into the stock? And in the case of Tesla, there's a ton of growth priced in, a lot of products that don't yet exist. General Motors, very, very cheap. A lot of people still think this company's in trouble, but it's generating billions and billions of cash every single year. So I'm going to dig into these two. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. First of all, let's look at a couple of charts. The first thing I want to look at is the free cash flow of these two companies, because I think the narrative is that Tesla is this massive growth company. It's extremely profitable, extremely high margins. But the reality is that General Motors is actually generating a lot more cash than Tesla is today. And you can see that the only time that Tesla ever reported more free cash flow than General Motors was in 2022. That was in the midst of that shortfall of supply that we had in the auto industry. A lot of automakers like General Motors canceled a lot of their chip orders early in the pandemic, thinking that they were just going to get back in line when demand started to pick up again. That obviously wasn't the case. So that left them undersupplied with chips and vehicles in turn. That ultimately drove a lot of growth for Tesla because Tesla didn't have the same supply constraints, a little bit more flexible in their usage of chips, and they were still in growth mode. They were still pushing forward in growing their production. So they were a huge beneficiary. They actually raised prices during this period of time, and that's why their margins were so high. That's why free cash flow was as high as it was. But now over the last year, or really 18 months, that started to reverse. Margins are coming down, and free cash flow is coming down as a result. So let's look at those operating trends, because I think this is really interesting. The first thing I'm going to show is gross margin. And you can see that gross margin for Tesla is higher than General Motors. The reason that we would expect that to be true is Tesla has its own dealerships. So they're not giving the margin that ends up going to dealerships to anybody else. General Motors, on the other hand, is basically a wholesaler of vehicles. So they're selling to dealers who are their partners, but that dealer needs to make a little bit of a margin. So let's say you're selling a $50,000 vehicle. If a dealership is making a $2,000 profit, GM's making a $5,000 profit, that's basically a 10% margin for GM. Tesla, on the other hand, is going to take that entire $7,000 as its own profit. That's going to be a $14,000 profit for Tesla. Now, there's going to be costs associated with running those dealerships. That's going to show up in the operating margin line. And that's why these numbers are so much closer together. Again, you can see the pandemic was the only time that Tesla exceeds General Motors from an operating margin perspective. And today, over the past year, margins are pretty close to where GM is today. So this is the dynamic that's going on in the auto industry today, is that Tesla has now reached the point where they don't have unlimited demand. They're having to play by the same laws of supply and demand as the rest of the market. There's competition. So now margins naturally come down. This is a difficult business to be in. There's a reason that automakers typically don't generate a lot of return for investors long term. And we haven't even been through a typical recession while Tesla has been a public company and a company that's actually producing vehicles at scale. The pandemic was this very strange recession that actually benefited Tesla in a lot of ways because of a lot of the mistakes that traditional automakers made. But now things are coming back to earth. And this is a big reason why Tesla's stock has taken a hit as a result. Why would Tesla stock react so negatively? That comes down to valuation. This is the price to sales multiple. What's crazy here is that GM basically doesn't even show up on this chart. Their price to sales multiple is 0.3. Tesla's price to sales multiple is 5.9. So Tesla is 20 times more expensive based on this metric. If you go over to price to earnings multiple, again, GM is extremely low, 5.6, and this 5.6 is their current price to earnings multiple. Tesla's current price to earnings multiple is 44.7. And like I said, those earnings are coming down. So this is the fundamental headwind that you're facing with Tesla, is that there's a ton of growth already priced into the stock. Depending on which kind of multiple you're looking at, the stock is 10 to 20 times more expensive than General Motors. So that's the reason that Tesla has underperformed GM over the past couple of years. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Is this trend going to continue? I think it absolutely is going to continue, and for a number of different reasons. One, General Motors is in a market where a lot of the competition is leaving the market. So they make most of their money selling trucks and SUVs. There's really no newcomers in the truck and SUV market for ICE production. So that's going to continue to be a cash flow machine for them. Electric vehicles is an area where General Motors is investing a lot of money. They're starting to introduce some vehicles, but that's just upside for them. That's just a way to kind of future-proof the business. Tesla, on the other hand, is facing more competition. Their margins are going to continue to shrink. Their free cash flow is going to continue to shrink. What investors are anticipating is that Tesla is going to transition to making most of its money with full self-driving, FSD. That is not a proven product. It's not a proven business model. They don't even have a very good attach rate for FSD with the vehicles that they're selling today. I think the better model would be General Motors and the business that they own, which is Cruise. They own a majority of Cruise. Cruise is building a fully autonomous vehicle, actually has millions of miles on the road with level 4 autonomy. Tesla is still making level 2 autonomy. They're not even testing level 3 or level 4 that we know of today. Yes, they have been promising artificial intelligence improvements. It seems like FSD is getting better and better, but we still don't have any data from them testing with a driver and actually giving us how many disengagements there are per mile, how many accidents are happening, what do those accidents look like. In fact, Tesla has spent a lot of time in court over the past couple of years fighting lawsuits and now settling lawsuits, something that Elon Musk said they would never do because of the accidents that have been involved. So I think this trend is going to continue because GM is going to continue generating cash flow. Cruise is going to continue to grow now in 2 cities. They're going to continue to expand that in the future. Tesla, I think, is going to have a much harder time launching FSD at any sort of scale, especially without a driver. That's a bridge that they still have not crossed, and we've been hearing that that's been coming for close to a decade now. But this is why Tesla has underperformed GM, and my bet is that it's going to continue to be the case. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.